You're listening to the Money Shift Podcast, a podcast that helps you downshift on bad financial habits and change gears to smarter strategies. We're talking about more than just debits and credits. We're paving the fast lane to financial freedom. Here's your host, Jack Paglo.
Welcome to the Money Shift Podcast. I'm Jack. We're with Eric Jorn, and today we're going to be talking about probably one of the most misunderstood topics in all of accounting and auto repair shop ownership. It's definitely something that I still really can't wrap my head around, and I have a little bit more training than some, auto repair shop owners. But without, being too long in my preamble here, we're going to be talking about basis. So, Eric, as quickly and as kind of as high level without getting too far into the jargon, what the heck is basis?
Yeah, wow, basis, right? That's seems like it's one of the biggest mysteries. And I'll be honest, even for tax professionals for a long time, basis is kind of like the redheaded stepchild where people are kind of putting it in its corner and ignoring it. A little bit more recently, the IRS has really added a lot more focus on making sure we're tracking basis, especially when we're talking about basis in entities. So, let's talk about the structure of that. We have business owners probably operating in one of two ways. Most of them are probably S corporations, especially listeners to this podcast. You're probably going to be an S corporation. The other entity that we're going to be tracking basis on is a partnership. And these are what's called pass-through entities, meaning the results of those businesses pass through to your personal tax return and are reported via a form called the K-1. And in between that is this world, what we call basis. And basis is a determination of, can we take money out of the business? Can we deduct losses? Or what happens when we retain profits inside of the business? And I like to look at basis as kind of a scorecard for your business. So what happened during the year, right? If we made profit increases basis. If we did something with that profit, so let's just say, hey, I took money out because I wanted to reward myself for working hard in the business, or I need it to support my lifestyle, right? That reduces basis. So it's kind of like actually the equity in your business. It actually should really reflect pretty closely the equity in your shop.
So, real quick, 20 grand in net income, bottom line, 20 grand in basis is really what I'm looking at. Assuming, I started with zero, didn't make any capital contributions or anything like that. Just opened the doors, took in 20 grand in net profit. I got 20 grand in basis if I didn't take any, money out of that business to reward myself or anything like that. That's as simple as it gets.
Simple as it gets example, right? That's exactly, and we left it all in the business. Yep. Now we're up 20 grand in basis, and that rolls to the next year. Now we start this next year with $20,000.
Now, let's say, again, second year in business, we got 20 grand. I need to get a lift. A lift's going to cost, let's just for round numbers, $10,000. What's that doing to the basis?
Well, it dovetails into a few things, right? So with basis, we're going to consider, let's just say we're an S corporation. Keep it simple. It's going to cover three things. What's my net profit for the year? What money did I take out of the business? And then what other type of expenses or losses I might want to deduct. So let's just say we had a rough year. It was break even. Maybe our lift broke, right? Took us almost half the year to source that new lift, but we finally got it. We had zero profit for the year before buying that lift. But now we bought the lift as well, and we have a $10,000 loss because of that, and we want to take that loss. Well, because in the prior year, we had $20,000 in profit, left it in the business, which established basis. It now allows us to actually take a loss, right? Because we're funding that loss with cash.
Okay, so that is a situation in which you can take that $10,000 loss that year, and then, but if I understand this, you have to have basis to take a loss. You can't, open your doors. So going backwards a little bit, you can't open your doors and then, what we brought in some money this year in total sales. Maybe we took in 20 grand in total sales, but to fund the business, we actually spent $50,000. So if we had a $30,000 net loss that year, that doesn't mean we have negative $30,000 in basis, does it?
Exactly. Basis cannot go below zero. So what happens then, right? So say instead of in our example, we carried forward that 20,000 in basis from the prior year, but say we operated a $50,000 loss, right? So now what we can do is we can take that $20,000 in loss and deduct it against other income on our personal tax return. That's what that basis allows us to do. But it's only up to that basis amount. The rest of that $30,000, that's now what's called suspended, right? We don't have enough basis to take that loss. So we have some suspended losses that we carry forward until we have basis to then take that loss. And the wrinkle is, right, how did we fund that loss? So here's the correlation that we run into.
Yeah, keep going.
Yeah. So more than likely, we funded that loss in one of two ways. I infused more cash into the business, which actually does give me basis, right? If I am a shareholder and I give a loan back to my business, that actually gives me basis. Otherwise, if we went out and went to a bank or loaded it up on our credit card or took a line of credit and we use that to fund that loss, now all of a sudden we don't get credit for that. We don't get basis. And here's where things get really complex. I'm a partnership. Those rules are different. If I personally guarantee debt as a partner inside of a partnership, now all of a sudden I get basis for debt.
What's the difference? And I guess without trying to put yourself in the mind of the IRS, why would this be the case?
Sure. An S corporation is looked at as much more as a divisible tax entity from you, meaning I have a corporation, I'm a shareholder, and I am employed as an employee of that corporation. Whereas a partnership, right, either a partnership or even if you're an LLC that's taxed as a partnership, from a tax side of things, either one is treated exactly the same. So either I'm a member or I'm a partner. Now, members and partners of partnerships don't take a W-2. I'm not employed by the partnership. I'm one of the partners of that partnership. So now part of me and my personal activity actually is part of the whole tax scheme within that business. So if I'm infusing debt into the partnership, it does give me basis for it.
Gotcha. Okay. So, I know you mentioned the scorecard of how the business is doing. It's kind of what you've already paid taxes on so far. You mentioned something kind of before we got into this about how there's two different types of basis, and I feel like we've only really been talking about one type of basis. So let's, take a step back and, what types of bases are there and which ones are, auto shop owners primarily going to be running into?
Yeah. I mean, right. So we're talking about basis. We've been talking about basis in the entity. And that's super important, right? Because if we take out too much in distribution, so say I get some debt, put some money, cash in my bank, I don't run a profit and I take out too much in distributions, more than I had basis for. Well, now I have a taxable event. I'm paying capital gains on those excess distributions. So that's one thing I want to watch out for. Another thing we run into is I call them basis traps. I have multiple operating entities. So, and here's what we see happen all the time. I have my existing shop. It's a cash cow, right? It's generating good cash flow. Hey, great news. Guess what I'm going to go do? I'm going to go buy a second location. So now I open up another S corporation. I go to the bank. Bank has me put 10% down on a note, and they're going to finance the acquisition for the rest of it. And what happens is when we do that, if we're doing a good job advising a shop owner, we're going to talk something about what's called the asset allocation on that purchase. And what that does is it gives us some items that we can depreciate 100% in the first year. And what we want to do is take those depreciation deductions in this new entity and this new business that we bought and offset them against the profits in our original shop, that's the cash cow that's making all the profits. Now, remember when I said when you use debt to fund losses in year one of an acquisition, right? We see losses pretty much regularly. When we use debt, we might not have basis to take those losses. So now I'm using a profitable shop to fund losses for this other shop here, but my losses are stuck because I use debt to fund it.
Is there a way that you can unstick those losses, for lack of a better term? Or is I mean, other than just not using debt? I'm assuming that's obviously the best option, but
yeah, I mean, when you're working with somebody who is talking to you on, about long-term, what do you want to do, right? Hey, I want to acquire 3, 5, 10 shops and run as an enterprise. We might structure our entities differently so they don't work in these multiple silos for each location, right? We want to see all these shops roll up into some sort of holding company where we stop. That breaks down what we call those basis traps, especially because when we're talking at that stage, we're doing things called leverage buyouts, where, in the world of investing in wealth creation, cash is king, right? So we want to use the least amount of cash possible to finance acquisitions. And we can get into that world in a whole different podcast episodes. So this is why basis is important for shop owners, right? Basis is the scorecard for those opportunities.
I never thought about it like that. I always, as somebody who understood from the legal, not even understood it like I'm a lawyer, but understood it from a legal side of things, why you have a holding company, why you're trying to protect your assets, even from certain tax plays. It makes some sense as to why you're going to keep some businesses separate. You're going to have your property LLC, you're going to have your auto shop LLC, you might have your loaner car LLC, depending upon, so on. I never thought about how you roll all that up into a holding company from a basis perspective and how that gets you out of that trap. That makes perfect sense. I thought it was just adding a little bit more complexity to avoid a lot of the legal plays, but there's so much more to that.
Well, you got to remember, accountants and attorneys just love to make things more complex.
Well, that's kind of what I thought it was.
No. There should be play, right? There should be a why behind the strategy that you're doing, and they should be pretty good whys, especially when you add complexity. So that's a big reason we do it, and there's all sorts of other reasons why it makes sense to maybe have a consolidator type entity that's a holdco for an enterprise. But let's talk about basis in a different respect, right? Hey, you might hear some verbiage thrown around like, hey, I got to depreciate or amortize this asset. Does it go on the balance sheet or does it go on the P&L when I say buy that $10,000 lift? So when we talk about basis in an actual asset that the business owns, we're talking about what we haven't depreciated or amortized in that asset.
So if I have that, back to that $10,000 lift example that we were using at the very beginning, if I bought that $10,000 lift, I can depreciate, let's say, again, I'm going to pick a number. I don't know if I'm spot on with this, but let's say I can depreciate 80% of that year one. Mm-hmm. Now there's $2,000 left in that asset that hasn't been depreciated. So I have $2,000 in basis in that asset, is what you're saying.
Correct. So now let's turn around and say, and let's maybe even call this, Jack, you're a big Porsche fan, right? So we bought a Porsche. Let's just say we bought
the garage going.
Say we bought a $40,000 Porsche, right? And we depreciated, let's call it 80,000 of that. And my math sometimes is not very good, but I believe that's $32,000 in depreciation, meaning we have $8,000 left in basis on that $40,000 Porsche that we bought. And that's tax basis, depreciable basis. You'll hear those terms thrown around. Now we're going to go into the next year and somebody comes by and they have a cooler Porsche that we want to buy. And we got to sell this one. We're going to sell our existing Porsche that we just took deductions for to go buy this next one. And you said, well, I bought it for 40 and now I'm selling it for 30 and I get to take a loss, right?
So it's not that $10,000 loss that I think I could be taking is what you're getting.
Exactly. It's not, right? Because we wrote that thing all the way down to $8,000, and we actually have what's called a gain, and a new term for everybody is what's called depreciation recapture. It's part of that gain, right? So if I bought that car for $40,000 and sold it for 50, that $10,000 gain from what I bought it for versus what I sold it for is capital gains. Same with stocks, probably a little bit more familiar of a concept for everybody. But when we're talking about depreciation, right, and we said we bought it for 40,000, we wrote off 32,000 of it, and now we're selling it for 30,000. That $22,000 difference is now what's called depreciation recapture. And we're paying ordinary income tax rates, higher tax rates on that versus long-term capital gains.
So I guess that's slightly better in that you're paying income tax rates on it versus the long-term capital gains rates.
Yeah.
I guess it's always better if you can sell a car, make 10 grand on it, sell the car, make 10 grand on it. I don't think that's what we're saying.
But right. We said cash is king.
Exactly. But at the end of the day, that's fascinating because I think that's, how many people might want to keep a car inside the business, whether it's a little bit of a research and development project, which might be a podcast for a later date. Maybe it's a little bit of a marketing thing, which, obviously people like to do. Trying to get that, trying to scratch that itch from a car perspective is, really could get you into a little bit of trouble if you're not minding your P's and Q's when it comes to basis and how you've depreciated that asset already.
And I'll tell you a situation where this ends up really hitting home for the most part. We have a proprietor, somebody goes, right, they buy their shop and they've taken some profits and they bought tools and lifts and cars, whatever it may be. And we keep buying all these assets and then we go to sell it, right? And let's just say we bought the business for 300, we put another 200 into it. And now we go to sell it for $500K. And you're like, well, I shouldn't pay any tax, right? Because there's no difference. But over the 30 years, we've depreciated all those assets and we've taken write-offs. We didn't pay tax on the profits along the way because we've reinvested them. But since we've taken those deductions, we've depreciated them, or depreciable basis in those assets are now zero. We actually have gains on the entire transaction because we've done that. And that always becomes as a shock and a surprise to sellers I thought I wasn't going to pay tax on this transaction, but you do because you got benefits over the 30 years you operated it. You got those tax benefits then. But hey, if we took assets and we said, hey, they're worth less every year and we're going to take a tax write-off every year for that. Oh, wait, when we go to sell your business, it's now worth X. Well, we got to recapture that, right? Our estimates on that depreciation were wrong. Now we got to recapture that whole thing.
So it's basically like the IRS kind of recognized that they, some business owners, some pretty savvy individuals were getting a little bit of a free lunch there from a depreciation perspective. And that's where this basis thing started coming into play to try to capture some of that unrecognizable, tax revenue potentially. Not to bash the IRS because obviously that's easy to do. But, I guess that's really the logic behind why basis is important and why it's there is, you can't really double dip from that side of the tax perspective.
Yeah, right. So the U.S. tax code is something around 70,000 pages, and I think it might even be able to wrap around the whole entire world a time or two. I could be completely wrong on that. But the reason is, right, hey, we release tax law to motivate action, right? To people to get people to spend more, invest more, etc. And then the people that find all the nooks and crannies around that new tax code that you just introduced to do that, now we got to patch those up. And then we're rinse and repeat. And yeah, this could be a situation where they had done that and introduced concepts like depreciation recapture, etc.
I would have never thought there'd be an analogy between the IRS rule book and the racing rule book, but it's basically the same thing. Trying to keep this somewhat above board though and professional and not, drag us into the racing realm. You mentioned some, initial mistakes that a shop owner might make, but, what are some other things that come to mind quickly as far as, absolute basis no-nos, things to always keep in mind, as you might be, thinking about an acquisition and funding that acquisition with debt, or maybe, taking some money out of your business, or, buying some new equipment, or depreciating that for that matter. Like, what are some other things that, business owners need to be aware of there?
Yeah, I mean, I think the key takeaways on this is that when I get my K1 at the end of the year for my business, I might want to flip back to the page that's got my basis schedule on it and say, hey, how much basis do I have left in my business? And you can do that too on your financials, right? You can go to your balance sheet, look at your equity section. You're probably an S corporation, and there's going to be an account called AAA or accumulated adjustment account, or maybe they mistitled it and left it as retained earnings. S corps don't have retained earnings; they have AAA. Retained earnings are for C corps. But we'll take a look at that number, and it's going to correspond exactly to what your basis is. Now, you might have a shareholder loan wrinkle in there. And if you're a partnership and you're operating as a partnership, more than likely, you're operating a little bit more in a sophisticated capacity. Those are conversations around what basis you should be having with your tax advisor.
So to your point, if we see that, AAA, the accumulated adjustments account, or potentially the mislabeled retained earnings account is showing as a negative, that's a quick indication that we don't have any basis to be able to take out of,
Exactly. You probably have suspended losses at that point.
And so those suspended losses, I know we mentioned that in the very beginning, but the suspended losses, that's not money that goes away. It's not actually, suspended is the perfect word. It's not.
Suspended is the perfect word in it. Yep. So all we need to do is have some profits, which we don't draw out of the business. And what'll happen is those profits then will be offset by those suspended losses.
And then, I guess I always like to think about it, similar to how you were talking about, in a different topic, which maybe we should do one on this too, but, payroll taxes and reclassified income, or reclassifying 1099 expenses as wages because of, not being able to issue 1099s and the IRS does an audit. And, I'm kind of losing where I'm going with this. But the point I'm trying to get at is that, everybody kind of, from my side of things, always freaked out whenever, oh my God, there's an IRS audit. I wasn't able to issue a 1099. And what the heck's going to happen? Am I going to go to jail? It's like, no. And all it took was you saying pretty easily, like, okay, here's probably the worst case scenario, that those, particular wages get reclassified as, wages and not 1099, sublet expenses or something like that. And you're going to have to pay additional payroll taxes on that. And that's it. Yep. Now, that's not the best situation in the world, but it's not nearly as scary as I think most people initially make it out to be. And I'm trying in a roundabout way to say it's sort of the same thing with if you dip into that basis unknowingly, maybe. And worst case scenario, you're having to pay capital gains taxes on that money, which again, that's not something somebody wants to do, but that's how you kind of get your wrist slapped, and you know not to do that next time.
Yeah, I mean, right at the end of the day, when we're talking about tax laws, tax rules, everything is largely fixable and manageable. It might cost you money. We can deal with that. Now, the two things you really got to be worried about is paying sales tax and payroll tax, right? Because either way, you're stealing from somebody else. Because sales tax, you're just collecting it for time being and giving it off to the state. That can shut down your business pretty quickly if you're not paying your sales tax. Payroll tax means I'm stealing from my employees, right? That's money that we held back for Social Security, for Medicare, their federal withholding, possibly state withholding. That's that employee's money, part of their wage that you pay them. If you don't pay that in, that's also stealing. So those are two things you should be cognizant about. Hey, those are the things that, hey, I might get somebody knocking on my door. I could actually go to jail if I'm stealing stuff, stealing money like that. But otherwise, right, all these things are definitely fixable.
I think that's where, it's, again, from my perspective, when you're first starting out, you're not thinking about anything really to do with accounting. You're trying to get your shop off the ground. You're trying to pay your bills. You're trying to bring money in the door via new work and so on. As it grows, though, you're not overly aware of the complexities behind the scenes that are also growing with your business. And I think this, maybe getting basis perfectly right in the beginning isn't really that important to you, but as it grows, nobody, it's one of those things that you need to have ironed out. Maybe not ironed out, but at least you need to be aware of, so you don't end up costing yourself an additional $5,000 in taxes because you had to take capital gains on something that you shouldn't have had to do. And I think that's where, it's another one of those little, I guess the basis trap, like you said, is the best word, because it's one of those traps that if you don't even know it's there until it's too late, and yeah, you can get yourself out of it. But at the end of the day, I think that's where, whether it's this podcast or just trying to understand it a little bit could be helpful, because now it's, here's roughly what it is, and here's how I can avoid it and not cost myself that $5,000 tax bill that I didn't want to have. Because at the end of the day, that's, half of that lift that we were talking about, or a vacation, or any of these other things. And, not having to pay the IRS more than we want to is exactly what we're trying to do. So,
exactly.
I don't really think I could wrap it up better than that. But as we, kind of finish it up, anything else, kind of top of mind for you in shop owner's perspective to end this conversation?
Yeah, definitely. I mean, right. This is one topic in a multitude of topics on why you should be working with a CPA, an accountant, somebody that can really answer these questions and have those answers to you at your fingertips, instead of maybe going for a DIY solution or even somebody just locally in town that might be friendly. They might not always have that expertise that you need to really put yourself in a good position and long-term structure everything to make it, to really give you the ability to go and maximize on it, on what you're building. Definitely.
Yeah. I think the complexity as your business grows and as you want to continue to scale or add new locations. And that's exactly, where this comes into play. And it's, understanding basis a little bit is important, but really having somebody sitting in your corner, maximizing, your dollar and your time is where it gets, yeah. I lost that side of things, so we can edit that out. But I wanted to wrap that up in a better way. But I think ultimately there was a lot of good stuff here, and at the end of the day, check out Kaizen CPAs for some basis help. We'd be happy to help you. Otherwise, we'll see you on the next Money Shift podcast.
You've been listening to the Money Shift podcast. Make sure to subscribe and share with someone who needs a little shift in their financial life. See you on the next stretch of the road.